Today I'm going to speak about crisis and discontinuity and a simple generic model to try to capture effects that may be at play in some cases. So let me give you a few examples of crashes, discontinuities, crises. Some of them are endogenous and some of them are exogenous. And that's what's interesting about crisis, is that they're not always due to something that is easy to identify as an external cause. Many of them, especially in financial markets, seem to be coming from the dynamics of the system itself. So there's this famous crash of 1929 and many other crashes like 1987. And many, as I said, in many cases, I'll have to go to that later, there doesn't seem to be any particular news happening that day that explains why the market crashed on, for example, October 20, 1987. There was really nothing happening. And there's a lot of examples like that where, despite the absence of big news, the market moves a lot. So this is a very interesting graph, I think, of what happened in 2008. So this so-called TED spread, I won't go into the details, but essentially it measures how much banks distrust each other. So when it's low, it means that there's a good level of trust in the interbank lending system. But then as this increases, so you see there's a fast abrupt increase in the beginning of August 2007, then it remains high, but then there's a huge increase in October 2008, which is the beginning of the crisis, the Lehman demise and so on. So there's suddenly a complete loss of trust in the banking system from bankers themselves. This is a confidence index which drops in 2020, but this is COVID, so this is clearly an exogenous shock, and you cannot understand that when something like that happens, trust drops. This is a confidence index in Germany up to 2009, and you see again mirroring this loss of trust in the bank system. Suddenly the consumer index drops as well. This is an interesting crash, which is not very often discussed, because it's an object that is itself not obviously apparent. You have to measure it. So this is the correlation between the stock market and the bond market. Okay. So you have to measure it over some time scales. Here it's a 100-day in the past measure of how correlated stocks and bonds move together or move opposite to one another. And for many, many years before 1997, this was kind of positive, which is a kind of natural sign for the correlation between bonds and equities, because when bonds go up, it means that interest rate goes down. And bonds is calculated as something like the inverse of an interest rate. So when interest rates go down, it's good for the stock market, and so the stock market goes up. So this is a kind of natural sign, if you want. But then suddenly there's the so-called Asian crisis taking place then, and the market completely changes its convention. But in a matter of a few weeks, instead of being staunchly positive, this correlation becomes negative. And okay, I've stopped the graph here because it's from a publication that we did in 2004, but you can actually continue this graph up to 2020, and it's remained negative for like 20 years, 25 years. So it's really interesting. It's like the magnetic field of the Earth. It's positive for a very long time and then becomes negative. But what's interesting is the speed at which it becomes negative. So it's a little hard to understand from purely economic reasoning, this abrupt change of convention.
Perhaps because many people go for fundamentals.
Well,
But that's only a part of getting.
so let me tell you what the negative sign is associated to, and what it was associated to back then is the so-called flight to quality. So when the stock market goes down, people panic and they buy secure paper, which is the US bonds, and so bonds go up because people buy bonds when the stock market goes down. So there's a kind of change of rationale, sudden change of rationale behind this correlation.
Yeah, that's the one that I'm used to. So what explains, I mean, well, you have explained the positive correlation, but how come the sentiment wasn't there before 1998?
Well, because there was kind of trust in the system somehow, and then the Asian crisis injected an amount of anxiety, if you want, in the market, and then suddenly people, every time the market goes down, we're thinking, oh, maybe it's a big one, we should buy secure paper. Yes?
Yeah, but maybe the rationale is, let's say, maybe it's rationale to be conformistic. Such systems.
Well, I don't know if it's rational or not, but actually you can come up with a model that explains how the correlation can suddenly change because people all believe that the correlation is the opposite.
Yeah, when everybody else behaves in a certain way, it might make sense.
Right. So this is the aim of the paper that we wrote around this thing, is that indeed you can come up with a simple model that explains how you can abruptly change. But what is really striking, again, is the speed at which it happened. This is a 100-day moving average, but still on the scale of 100-day, this is extremely sharp and means that suddenly, whereas kind of every day stocks and bonds were moving in the same direction, then suddenly every day stocks and bonds are moving in the opposite direction. So it's a very striking thing. So other examples of spectacular events. I mean, this is the normalized birth rate in different countries in Europe, but here I've highlighted Germany and Portugal as a function of time. So this is the 60s, 70s, 80s, 90s. And you see this very sudden drop in normalized by the birth rate before 1960. And so you see a very abrupt change of behavior of motherhood in Germany, say in a matter of maybe 5 years, much slower in Portugal.
Just birth control, sorry.
Yeah, but birth control was available everywhere. So there's also a cultural aspect to this. I'm just showing. Yeah, of course.
Okay, sorry.
There's a triggering effect, but then the reaction can be very different.
Yeah. Okay.
So for example, here, that's maybe not as deep as this one, but this is data from how people clap at the end of concerts. And so this was my experience, and then we got data to quantify this, that in some cases, applauses drop very slowly. People continue applauding for a while, and then they stop, but it's a continuous phenomenon. And then in some other cases, you feel that there's a tension because people don't want to be caught alone clapping. And so as soon as the sound starts to drop, clapping dies out very quickly. And so this is actual data where you see two types of end of clapping. One which was very progressive and the other one which was pretty abrupt. And here is the derivative of these curves. And this is an interesting way to analyze the data. And I'll come to that later in terms of comparing this with the simple model I'm going to.
I've come across some papers in which claps also start like that. You also don't want to be the only one who's not clapping. So they also very abruptly start once one person starts clapping.
Yes, but it's very hard to see the opposite, where clapping starts very progressive.
Okay, I don't have data.
I mean, it seems strange to me. I mean, it's a convention nearly that at the end, the end of a concert, people start clapping, and it's kind of abrupt. But then the other way around, when people stop clapping, it's different because there's no convention for the duration of clapping. Okay, this is another spectacular effect that I just wanted to show is the famous inflation in the early 20s in Germany, where the mark devaluated from 1 to 1,000 billion, something like that. And actually, people also forget that in France, after the revolution, there was a huge inflation as well. And it was an economic catastrophe. This is another example from physics, but I like it a lot as well, which is the fact that depending on the material, as you strain the material, the stress increases, but in some cases, the stress stops increasing after a while, it becomes nearly constant, and then the material fails. So there's a kind of precursor to failure, which is the slowdown of the increase of stress as you strain the material. But it's so this is called ductile fracture or failure. But there's another type of material where it's so-called fragile, in the sense that you strain the material, the stress increases, and then all of a sudden, with no precursor at all, it breaks. So there's these two types of phenomena that somehow kind of resemble these types of phenomena. Okay, other discontinuities or abrupt surges or collapses. This is the way technology invades households in the US. So electric power, radio. I mean, there's a bunch of other ones that have been moved. That's color TV, computer, and smartphone. And you see, interestingly, that the speed at which technology is taking hold of consumers is actually speeding up at an incredible rate. This is a funny example of how surnames can pick up in a very abrupt manner. So this is the number of little girls called Stéphanie in France at a function of time. So in 1965, this little girl, the Stéphanie, Princess of Monaco, was born. And then everybody wanted to do the same. And so there was a kind of imitation phenomenon where at one point, the number of Stéphanie reached like 25,000 newborn. This is the way some words invade our vocabulary. So for example, here is the word around hygiene, hygiene, hygienic, hygienism. And around 1950, if you look at the frequency of occurrence of these words in published data, published articles, essentially, or books, then there's a sudden jump around 1850. Whereas in other cases, it's much more progressive, like telephone. It's more or less important.
Isn't it even more strange that you can have sudden drop in hygiene?
Yeah, and you know what that is? This is the First World War.
Right.
The hygiene was not a major
Correct.
application.
Okay, it's very hard to see the x-axis, so
Oh yeah, sorry. So this is no, but it's an interesting. So this is the First World War. This is the Second World War.
right.
Okay, these are things that are very striking. This is the so-called love lots. I don't know if you had that in the Netherlands, but in Paris, this is Pont des Arts in Paris, and so people find it, I don't know, they're motivated in showing their love by attaching a lot to the bridge. And I was actually crossing this bridge every day to go to work, and literally, it took 1 month for the bridge from being empty or essentially only a few of them to be completely full. So they actually had to remove these and put glass, plexiglass to avoid people doing this. So it was a very striking phenomenon of imitation. People were seeing that other people were doing this and they felt an urge to do the same. It's really striking. This is the Mexican wave in stadium, a very interesting phenomenon where I'm sure you've seen this, or if you go to stadium, it's not obvious how to start a Mexican wave. Some people try, and it dies out, and will try again, dies out, and then at one point it picks up and it propagates, and so there's a kind of threshold below which people are not interested, and above which it becomes self-fulfilling. What is interesting also from a kind of general standpoint is that there's nothing that in principle define the way the Mexican wave is going to rotate. It's going to rotate clockwise or counterclockwise. And so this is an example that physicists call symmetry breaking, because a priori both are possible. And I'm told, I don't know if it's true, but that in the UK it turns opposite to what in continental Europe. I mean, this is a statistical effect. And maybe it makes sense. Maybe it makes sense because we're trained to be more attentive to one side rather than the other, maybe related to equal ways of driving. But anyway, it's interesting.
Questions, did it change in Sweden? It changed.
Yeah, maybe it didn't exist back then,
I guess.
So there's also this phenomenon of riot propagation, and this was very much studied by sociologists and economists like Granovetter, Schelling, the way riots are started, a little bit like the Hola, the Mexican wave. Not enough people are rioting, then people are not feeling that they should join, but then beyond some threshold, some tipping point, then people may be incentivized to join just because more people are joining.
All examples of herding behavior.
Yeah, exactly.
So
Sure. All this is related to herding imitation. So this is also a very beautiful paper by the group of Jean-Pierre Nadal in Paris, where they analyzed, so maybe you know or you didn't remember, I don't know, that there were heavy riots in France in 2005, a little bit like this summer, after two kids died in an electric box because they were hiding from the police there. And it triggered a wave of riots, and so this is data in the Département 95 where it started, and so this is the number of riots as a function of time. So you see a peak and then it decays out, and they study the propagation of these riots across France. Actually, you can even study it locally within the Département 95, and you see that it starts somewhere and then it propagates from city to city, and it even propagates from one département to 59 is north of France. And so you see there's a lag. I mean, it starts here and then there's a lag and it starts here. And you can kind of calibrate these imitation herding models to account for that.
Can I ask a question?
Sure, of course.
It's based on slide 2.
Oops. I'm sorry?
Slide 2.
Slide 2.
I want to challenge the basic premise that we are trying to find causations, linear causations, like a war or slide before this one.
After this one. This one? This one?
Before this 2, this is 4. Yes, yes. In this slide, you showed that there was you checked the news and nothing was really happening those days when you see the crashes or the crises. So I want to challenge the premise that we are trying to find causations. We are trying to find reasons that causes a crisis or a crash or a peak.
Mhm.
But maybe it's very natural to have peaks without having a causation to it. For example, landslides, they just happen. There's no nothing. They just slide and.
Yeah, sure.
So
But it's because they're landslides because the system is fragile. It's prone to having these endogenously triggered events. I mean, if you have a stable soil, you won't have landslides. It's really the paradigm of sandpipe. But maybe if you let me, for the moment, this is just illustration of various phenomena. I haven't said anything about the explanation. But you know, that's where I was about to go. I mean, this is a study that we did a long time ago and then repeated recently. If you look at price jumps in the US stock market, these are price jumps at the minute level. So these are really huge on the scale of the local volatility. I mean, these are 4 sigma events. So they shouldn't even exist in the Gaussian world, as we said this all yesterday. And when you look at the news feed around these jumps, in most cases, there's nothing going on. I mean, there's nothing that can explain why this stock at this particular moment had such a jump. And actually, you can distinguish those which jump because there was some news and those which jump because you couldn't identify any news. And you know, it's a very rough sketch, and you have to be more precise and read our paper. But essentially, those with these jumps that happen with news, essentially the volatility. This is if you want the activity, the level of movement of the stock before the jump is low and shows nothing special. And then the news is printed and becomes available, and then there's a jump, and then the market relaxes. I mean, after a while, the news gets digested, if you want, and the market gets calmer again. So this is what you would expect when it's triggered by a news, because nobody expected that news, and the news it becomes available and then jumps. But in many cases, the profile of these jumps is extremely symmetric. So there's actually a rise of activity before the jump, and then a decay of activity after the jump. And when you fit these jumps, the profile actually is very symmetric. And so it's very natural to think that there are 2 types of events. One type of events which can be called exogenous, there was a real reason for the stock to move that much, and another reason which seems that the market seems to self-excite itself to a point where it becomes unstable and then restabilizes. And so what's interesting about the shape of these profiles is that they've been seen in very different examples. And even quantitatively, the shape of these profiles are very similar to the 2 examples I've shown above here. One is Amazon book sales. So this is whereby this on it. And you see exactly the same kind of distinction between exogenous shocks and endogenous shocks. So exogenous shocks would mean there's a newspaper article published about the book, or the author is interviewed on TV or something. And so suddenly people become aware of the book. There's a huge spike in sales, and then it decays back. But there's another phenomenon by which books can be sold, is a kind of word of mouth phenomenon. And there you see a progressive increase of activity around the book, then it peaks and then it goes back down. So it's very suggestive that there is there's commonality between these 2 types of phenomena. This is another example, but the same story. This is YouTube views. So again, you can publish a YouTube video and make it known, and it corresponds to something that everybody's aware of suddenly. And you have this type of jump in the number of, so this is daily view count. So it jumps and then it goes back down. But in other cases, there's, someone discovers the YouTube and tells his or her friends, and it propagates, and it's much more progressive, peaks, and then goes back down. And again, what's remarkable is that, I don't explain right now that the shape of this decay can be fitted by a model which is called Hawkes processes, which was invented in the context of earthquakes and tries to describe this feedback loop of activity on itself, the self-excitation loop. And it turns out, to our surprise, that maybe it's a coincidence, but even the fitting parameters needed to explain the shape of endogenous jumps in the two cases is, three cases is very similar. Maybe there's something related to human behavior in the way we process information.
The point.
One question on the, so I can imagine that at some point, either AI or traders through AI, whatever, start learning these patterns, and then by learning them, changing them. Do you see that happening, or?
It's a very interesting question. Some things do change in markets, other things are very constant. What I can tell you, but maybe it's too early, is that so we did the first analysis in 2008 with data which was obviously pre-2008, and we found exactly the same results when we redid this analysis with Riccardo Marcaccioli a few years ago on data that was 15 years older than the first set. But of course, you can argue that maybe very sophisticated AI systems are not yet at play on these time scales, and they will progressively become that. But false, maybe. But I have the impression that, and that's what we are trying to suggest in the paper, that this is really entrenched in the way markets function. So when there's a news, okay, but if you think about what happens at a microscopic scale here, as soon as activity seems to pick up for random reasons, then it sends a kind of warning sign signal to market makers, to liquidity providers, who are the one who would suffer in case of jumps. And so, it's a statistical effect, but as soon as volatility increases for arbitrary reasons, then liquidity decreases a little bit. And if liquidity decreases, you may have more volatility because any trade might move the market more if there's less liquidity.
Yeah.
And so you see the feedback loop that can start being at play. And our interpretation is that this is what is happening. That then we have also micro level data that seems to suggest that indeed this feedback loop is at play. But intuitively, this is exactly what, if you were a market maker, that's what you would encode in your system, because market makers are not humans anymore. We were discussing the high C traders. And so if you were to code an algorithm for market making, then you would put these feedback loop hard coded, because this is a kind of risk protection.
Yeah. I think to your point, I think what you're also, just to address your point, I think it's not suggesting that this is bad, right? You're not, the volatility has a function in markets as
For the
well.
moment, I'm just describing.
Just describing it. So to your point that it's not.
Yeah, more commenting. If you would be able to predict such spikes or peaks, then and the market would not be totally homogeneous, or at least prediction power, then it would probably pull the peak a little bit to the left.
Yes.
No, I agree. I was just curious because you are studying these things. I was just curious what you'd seen.
So as I say, surprisingly, I mean, we were really surprised. We did this study a second time with slightly different ideas and also inspired by these papers here. But the shape of this decay and the, you know,
To some extent, I find the decay more interesting in the.
yeah, so if you, by the way, so the decay is faster here than here.
Yeah.
Which is consistent with, well, also, first of all, the mathematical model tells you that the exponent describing this parallel decay here should be half of that one, and this is borne out by data. Data, I mean, of course, up to error bars, but it's okay. It's consistent what it seems to be with the data, but also intuitively, when something happens and the market knows why there was volatility, it's easier to calm down sometimes. But if something happens and nobody knows why, it's much more difficult to calm down. So it takes longer for relaxation after these jumps than after these, which is a little counterintuitive at first, because you would think, okay, maybe if nothing happens, markets should calm down. But the problem is that nobody knows why it happened.
So it's probably uncertainty.
Yeah, right. Exactly. Whereas here, okay, there was a bad news, but no, everybody knows it. And so we can come back to business as usual somehow.
Yeah, but the point is, even with that is, I think, also her remark. The causality looks like it is a news event, and then you see the spike.
But yeah, and that's
I'm not familiar with that graph per se, but if you look at stock markets.
But here we have the news.
Yeah, but it is exactly the opposite around. There's a lot of material around it, maybe not in this specific. I don't know if it applies to this type of graph, but in stock markets it's the other way around.
But this is done.
Stock precedes news.
Yeah, you think so? Yeah, that's what I mean. No, but that's not people don't believe that.
No.
If the news is an earthquake, then the stock cannot trigger the earthquake. Right?
No, it's not. If it's not
the idea is
the news, it's insider trading.
No,
People would not do that.
No, it's not insider trading.
Well, of course not. You're not supposed to know the news before it's made public.
Yeah, but it is the other way around.
By the way, if
I will come back to it later.
If you have private information, the last thing you want to do is to make the price.
Yeah, but I'm not talking about that. I have multiple examples for that. Let's.
Okay, but anyway, this is actual data. This is real data. And
the data is nothing wrong with it.
Yeah, but we have both the price data and the news data. And I'm not saying that this is the news because I think it's a news.
But it ties to what kind of event. Maybe another event could also be happening there. So it is not about the event, the exact event that triggers it. It can also happen, and then in hindsight you can say, okay, this will be the event.
Here it's a 1 minute resolution. We know at that point there was a news with a tag corresponding to the stock that we're looking
I
at.
suspect your examples are more related to the bottom right figure.
Exactly.
There's something in the air, and some people are.
But I'm interested
That is
that maybe as more.
Maybe, but again, I think that if you know something and you think about how to use this information, the last thing you want to do is to make the price drop. You should.
No, but I think it's more related to trends and it is
So maybe only to the right.
Yeah.
So
I mean, but that's the point. If you see a trend, then this is the feedback loop. And when you see a trend coupled with an increased volatility, there's a feedback loop between trends and volatility that you can calibrate in normal periods. But it also predicts that in some periods it's going to go all right.
Yeah. And having been in a large public company, this is also what happens if you're in a company. You're like, what happened in the stock market? Nothing happened to us.
Right.
It's really funny.
Yeah, but I mean, you're looking at these data every day.
Yeah, exactly.
Company. That's right.
Yeah.
So I think you had something else. Someone else had some.
On the exogenous graph, I'm thinking, I'm just bluntly thinking, the terrorist activities, for example.
I'm sorry?
Terrorist activities.
Yes.
For example, 9/11 or the Taj Mumbai case where it was an artificial spike in how people started thinking about terrorism after that, but it was building up. It was created by humans. Some people, they were planting the bombs and planning this for years, and then they created the spike, not as, it was like a silent planning.
I'm not sure you see that in stock markets though.
Sorry.
I'm not sure you would see that in stock markets.
But based on my experience with movies of finances, I'm not from finance background. They say that they can plan these things, and then competitors can, I don't know, just plan these spikes so that it affects them.
I don't know.
That's what,
Okay,
One more question.
oh, sorry, yeah, I thought you had a question and you were.
Related to the point that the left one decreases about twice as fast, so the right one for the data. Is that also because it's like more explainable, there's some news triggering this increases. It also explains the fact that these exogenous events have a higher peak on what I see on average than the.
You're absolutely right, and this also makes sense. I mean, when there's an exogenous shock, I mean, so roughly speaking, in terms of proportions, this is 95% of the cases, and this is 5% of the cases. And we know that stock markets move much too much compared to fundamentals. But then it doesn't mean to say, even if the news events are much rarer, that they're not impactful. And indeed, when they happen, they do impact. And we've seen that many times, like, you know, when the latest example I have in mind is when Pfizer announced the vaccine, the COVID vaccine in November 2020, there was a huge spike. And obviously these cases, they exist. But what's interesting is that although they exist, they are very rare compared to a lot of jumps that are much more numerous and not and smaller in magnitude. But still, I mean, here the jumps that are included in the study are 4 sigma jumps. So they are, again, they are big. I mean, it's really a price change that is beyond what you would expect in a Gaussian world. And it's 4 sigma with a sigma that's local. It's a sigma that's not computed over years. It's a local volatility over a few hours before the jump. So, you know, in days that are volatile for other reasons, these would not be counted as jumps. They are really jumps in the sense that they're unexpected price changes, even with respect to the local value of the price. Okay, so this was my introduction.
you said you see similar things in the stock market, YouTube clips and book sales. The bottom right example for the stock market was also related to the book sales.
Yeah, this one is really very much like this one or this one.
Yeah.
And as I said, with the same value of parameters for the shape of the build-up and the
also
decay.
the 4 sigma kind of deviations order of magnitude.
So I don't remember what were their thresholds, but you know, it's
both
something that's deemed significant. Okay, now I want to tell you about a model that's called the random field Ising model in physics, but I won't talk much about physics. I want to show you the structure of the model and how it's very versatile and defined model that I think is really interesting to study. So, as I said, initially it was introduced as a kind of simplified model for disordered magnets, but you can think of that as a generic model leading to a transition between individual behavior and collective behavior. So, you know, essentially what I try to motivate up to now is that there are curves that are more or less continuous and smooth, and they probably reflect heterogeneity of preferences of individual agents. But then in some cases, it's not at all a smooth curve, it's more a kind of abrupt change of mood or crash and so on. And so this is what this model is going to be able to capture. In some cases, individuals rule the observation, and in other cases, it's really the imitation and validating and collective effects. So the model is the following. So each agent has a binary decision to make. That's +1 or -1, which can be in the banking crisis 2008. Do I trust the system or do I don't trust the system? Do I buy? Do I sell? Do I vote or do I abstain from voting? And so on and so forth. Do I clap or do I stop clapping? You see, a broad range of phenomena where it's a binary thing. Of course, there are cases where it's non-binary. That's having a child, not having a child, buying a cell phone, not buying a cell phone. All these things are binary in the sense that you're not going to buy two cell phones. I mean, it's like one cell phone.
You can have twins though.
I'm sorry?
You can have twins though. Regarding getting a child or not, you can have twins.
Oh, yeah, sure. Okay.
But that's a decision, but that's not the result.
Yeah, that's the decision. And so, okay, so the model tells you, okay, what is determining your decision to buy, say? Well, it's going to be a combination of three things. One is an individual propensity to do that. And I'm going to call this HI. This is a individual propensity. It's random. People have different preferences. And so I'm going to assume that it's distributed according to some law of age. And, you know, in terms of technology, there are people, so think about cell phones, because this is also some data that we analyzed, the way cell phones invaded. I've shown you what's graph before in the case of US technology. So it's oh no, I don't have, this is a smartphone. That's the cell phone was much earlier. It kind of resembles this one, but we have data for different countries as well. So this is something I'm going to show later. But so, you know, there are kind of technological aficionados. As soon as there's something new, they buy it. And then people who don't care. I don't know, at the time, my grandmother, she passed away a long time ago, but she was probably one of the last to buy a cell phone. I don't think she ever had one. So this describes this propensity. I mean, if HI is very, very negative, it means that you're going to be extremely late in the game. If HI is very positive, you'll be among the first ones to adopt. Actually, this is a very important aspect in marketing. How, when you create a new product, how it's going to invade the markets. There are the forerunners and then the late adopters and so on. So I'm going to mention that. Then the second thing that affects your decision to buy or not to buy is what I call H of T here, capital H, which is the same for all I. So I is the label of the agent, and so it's public information. So it could be the price, it could be the quality. So again, if you remember, maybe some of you are too young to remember that, but when cell phones arrived in the mid-90s, technology was pretty bad. I mean, it was there was a lot of noise, of spurious noise, and it was a bad quality product, and so that was deterring people from buying. And then as technology or price or both improve, then H increases, and it allows some people who were reluctant to flip from non-buyers to buyers. And then the most important aspect of this model, although the three terms are important, but the new aspect of the model that makes sense in physics, but that also makes sense from our everyday experience in real life, is that we are sensitive to the decisions of our peers, right? So this is a kind of social pressure term. It's a sum over your neighbors of some influence matrix that I denoted JIJ, a little bit like this state, times the decision of your neighbor at the previous time. And so you make a kind of mixture of these three terms, and this determines if it's positive, you're going to buy, if it's negative, you're going to sell. So if nobody buys, you're not going to buy because nobody buys, and if everybody buys, you're going to buy because everybody buys. This is the idea of this term. JIJ here is positive, which means that we're going to focus on mutation, but of course you can think that in some cases there are contrarians, people who actually want to do the opposite, whatever we want, but let's forget that for a moment. Okay, so that's the model.
Sociologists call this the threshold model.
Yes,
So,
it is the threshold model.
So of course, in an Ising model, you could think of the space splitting back as well, but like buying a cell phone, you cannot unbuy a cell phone anymore.
So this is so what we're going to study is a case where H of T has a smooth monotonic behavior, and so spins don't unflip,
Right.
although they could unflip in some cases, but maybe it's going to be clear.
Can I ask one?
Yeah, sure.
Question? So the social pressure, could you also replace that with the fact that we know that a technology, like a real new technology like hydrogen, can only succeed if everyone invests in it?
Mhm.
So is that a different factor? So the simple fact is that if nobody chooses hydrogen,
No, I think it's the same. It's
is
really
that
the
you can
same.
include it in the social pressure
Yeah.
part that we.
Maybe you would also need it in the public information, because maybe the quality of the service improves if there are many people that adopt
Yeah,
it.
exactly. So I think that here it's hidden in the choice you make of the JIJ. If the JIJ are local, so you speak to your neighbors only, it's really a kind of social pressure term. If JIJ includes everybody, then the only thing that is going to matter is the overall consumption. And the overall consumption is going to be public information.
But there could be maybe an intermediate case. For example, let's say electric cars. So if everybody hears there's way too few stations that you can charge electric cars, then people don't buy it. But it's not peer pressure. I'm not going to buy or not buy an electric car because of my neighbor telling me, but because I'm afraid there are not enough charging stations. But once
Yeah.
there are enough, then you could put it in the
But
age.
then this is age.
Yeah, but
This is
age
age.
could in principle also depend in some way on
Yeah,
the
yeah.
average of S, because if there are more people buying it, then the company will put more charging.
But that's what I'm saying. So you can have the average of S in this term and then decide to include it in H. I mean, it's a
Yeah, okay,
kind of-
okay.
it's a
that's-
kind
I
of-
would put it in H, but
Yeah,
It goes,
No, just,
Right.
okay.
you have T-1 in there, but I think what you're talking about would be the perception of future decision of your peers.
Okay,
But we don't.
then how do you model this?
Yeah.
And
That's-
in general, so no, but that's interesting, and so you can, for example, something that is very natural is to include a trend term. Is that it would not only be the state at T-1, but the difference between T-1 and T-2, for example,
Yeah.
be another
Yeah.
term, and so people would be tempted to follow the trend.
What's the perception of what's going to happen?
Okay.
but
So
I also
that's
think
an
her
addition.
comment is related to what you believe about public information and markets, because do you believe the aggression is market hypothesis? Everything that publicly available information everybody knows and applies basically, or not? And a lot of people believe that if it's publicly known, everybody uses it, but I
Okay.
don't.
Sure, I mean,
And that ties to that, because then HT is only applied for a part of the population, and then the other part can be
yeah.
included in the other.
Again, it's like the model of yesterday. I mean, there are huge numbers of possible variations that you can think of. So here I'm looking at the simplest case where age is common to everybody, but of course you could have an age different from half of the population and the other half. So
Yeah, that's also
and you
true.
could play with different things. So let me try to
Yeah, we keep it simple, sorry.
start with the simplest case and then
Yeah. I just
So-
wanted to know if it's
so-
already work. Yeah.
So what's interesting about this, as we'll see, is that this very simple model leads already to multiple equilibria. Hysteresis, that is, that you can be out of equilibrium. The real equilibrium, the true equilibrium is elsewhere, but you're stuck in the one that you're in, and that it triggers this idea of avalanches, of discontinuities. That is, if you want, of price jumps of many sizes and so on. So let me tell you what you get, and again, this is something that we can investigate more this afternoon in the hands-on session. So let me look at the case that we alluded to, where everybody looks at everybody else with the same rate. So where actually this social pressure boils down to the total consumption. So, we're aware, for example, of the number of attendance to a movie because it's published in a week. So it's not really a local thing with your friends, it's a global thing that tells you that other people have gone to that movie and liked it. So Jij is the same for all IJs. So the only thing that matters is the average of Sj at the previous time step, which is the total consumption, or these are global averages.
I have a question.
Yes?
Again with the formula, but there's also resistance for a new technology that comes in. So we are in this equation, we are assuming that social pressure is always positive.
Yeah,
But then
that's what I said. I mean, I'm starting the fact that they are contrarians. Maybe you want to add contrarians. I'm not adding contrarians, but the resistance is also here because there's a lot of people who are not interested at all in the movie or in the cell phone or whatever. So this is a huge aspect of resistance.
because social pressure can also be negative. In this equation, it's only
I
positive.
agree. I agree. I said that. I said that.
Sorry.
I have no contrarians in the model, but you can add contrarians, sure. Okay, so what happens in this model? Well, let's look at the solution for the average consumption, which I've noted here, M, which is 1 over n sum of rho of SI. So it's -1 if nobody buys, and if it's 1 when everybody buys. And so let's think of that as a story of cell phones. H is improving. So as I said, technology or price is improving. And then, if there's no imitation, if there's no social pressure, or if social pressure is less than some threshold that we will compute this afternoon, then the curve here is smooth, and it basically reflects individual preferences. So that's what I was saying here. These are the early adopters, the ones, despite the fact that price is high and nobody buys, they still want to buy. And then it increases because you reach the bulk of the distribution, people buy more and more, and then it saturates. So this is a kind of standard adoption curve.
Just a CDF of normal
Yeah.
distribution.
It's exactly that, the CDF of the distribution, albeit slightly distorted already by J, but not that much. We'll see that this afternoon. It remains smooth. It's always smooth. But then when J becomes larger than that critical value, the curve really radically changes in the sense that there's a true discontinuity that appears. So the curve is not smooth. And in the large n limit, there's a discontinuity at one point where suddenly consumption, which was very small because nobody wanted to buy. And so at one point, I remember in the 90s, it was considered ridiculous to have a cell phone. It's a crazy idea. I mean, to walk around in the street with a cell phone. I don't want to do that. It's funny how things change. And then suddenly, here, you still improve the technology and so on. And at one point, people will say, you know what, the hell with it, I'm going to buy it. And then, because they buy it, everybody else is going to buy it. And then you can have a jump. So you have a true discontinuity. So here it's emphasized, of course. I mean, there are intermediate cases where the jump is much smaller. So the curve would do like this, and then jump here, and then like this. But mathematically, you go from a regime where it's a smooth curve to a regime where it's a discontinuous curve, which reflects the fact that now social pressure has become more dominant.
Is this equilibrium or is this a simulation in time?
So this is really, so here there's a unique equilibrium. So you don't even have to speak about the history. It's this, you'll get the same. But that was exactly what I was about to mention.
Sorry.
Is now, no, Okay, now the curve depends on which way you're traveling, and it depends on history. So if you start here with a low adoption rate, then you're going to follow this line here. But there's actually another line that's possible that's equally good from the point of view of equilibrium. But you'll never get there. And actually, in terms of social satisfaction, as soon as you cross this point, you should actually be here, but you're stuck here. So it's like, you know, and I'll mention that later, but it's really, I think, very much related to conundrums that we see right now about, for example, as you were mentioning, energy transition and so on. You know, nobody wants to be here because everybody is here and in a self-conscious manner. We are not doing the right thing collectively, and it's really a way to break this this problem that is, in my mind, one of the major issues of the energy transition.
With cell phones, there was massive subsidizing by the cell phone not by the cell phone, by the cellular network.
Yeah, this is HFT.
They keep like more than 100% subscription rates to be able to offer the phones for almost free.
And this is also understanding that from a marketing point of view, if you reach this point, then you're in business, literally. But I'll go back to that later.
Cars, so getting the mass.
About a threshold. So imagine a situation. You could imagine other situations where, you know, it goes in that direction first, you reach this point, and then you go back down. And I'll give an example of that later. But so you see that if you go back down, so think about this as in the other way. So like in 2008, a kind of picture, a narrative of what could have happened is that people were here optimistic about the economy because everybody else was optimistic. And actually there are interviews of major bankers who say that, you know, everybody was dancing because everybody else was dancing. And then, you know, bad news accumulates over the situation, in particular the subprime debt and so on, and the actual balance sheet of banks. So, you know, there's more and more bad news about this, and then suddenly it becomes unsustainable. And then there's a crash. Everybody starts mistrusting the system, and we see this LIBOR, this debt spread exploding, meaning that nobody trusts anymore the system, and you're here. But you see that if these social pressure effects are strong, it means that as the economy is getting better objectively, instead of getting back up quickly, you're going to be stuck there for ages.
But I'd like to add a comment on the perception again, because let's say you have a real estate somewhere, but what moves people is the perception, and there's a lot of deception going on in many places, and I think.
But that's in the model.
That can explain,
that's in the model.
It's in the model, but you can see it as a bug, this kind of hysteresis thing that you only get a shift after you got past a very large threshold, whereas it would be more optimal if you would have moved before. But then given a lot of, let's say, noise and deception in information people have, it may make sense to be more conservative and
but maybe, but I'm saying that, you know, if you assume that you should really be sensitive to news, to real news, and that's why I think it's interesting to have this two kind of behavior in the same model, because, you know, here you don't pay attention to what other people are thinking, and you're actually following the news, the objective news.
No, but that's where my comment, because the objective news is, well, made by, let's say, those who sell cell phones.
But then relying on others is a very risky bet.
It's somewhat, but apparently people trust their peers often much more than salesmen. And it's not ridiculous if you buy everything.
No.
Yeah, you can debate. I mean, the debate on.
But
on
I
fact-
agree, it's not always functional, but it's also not always
Yeah,
this.
sure. And actually, there's a very interesting story about this related to the wisdom of crowds.
Yeah.
Because this is related to the wisdom of crowds. But you see that the wisdom of crowds has a paradoxical twist in it, which is that you should trust the crowd maybe because it aggregates information. But on the other hand, if nobody looks for information, then it's also related to the Grossman-Stiglitz paradox. So if nobody looks for that information anymore, then the wisdom of crowd is completely useless. So you have to imagine a scenario by which the system is stable with people who just follow the crowd.
And the more stupid the crowd is, the more it makes sense to look for information.
Exactly. Yeah. But in some cases, anyway, so it's a long debate. But here again, I mean, the model is the model, and the way you interpret the model is depends on what you want to do and what your assumption is. But if you believe that for whatever reason, if it's rational or irrational, it doesn't matter. If people follow the crowd, then that's what you're going to get. And maybe that's not what we want to get.
Do you think, so investors today, I think, assume they're looking for blue types of
Yeah, I mean, I think,
terms.
Efficient market hypothesis,
Yeah.
for example, means that we're on
It's
the
like a blue line, and so the
that
problem is
people do
because
the
we are,
homework themselves and
Yeah.
and
because we are so interconnected, we get the red.
Right.
And so because of that, we are not. Do you think that might be a
You
reason
can
why
exploit
we're
it.
not investing enough in some of the real bigger
Sure.
in energy, because they're just simply expecting the blue lines, they're not seeing them, and then they say, oh, this is not a good technology.
Yeah, sure. Yeah. You don't want to invest in, for example, ESG technology because nobody else wants to invest.
Yeah.
And it becomes a self-fulfilling prophecy.
And they
this
believe
is-
in their model.
This is the model of self-fulfilling prophecy. There's
Yeah.
also another ways.
Following up on his thoughts, often government makes rules in collaboration with companies to make us behave in a certain way, to make the crowd behave in a certain way. For example, this Billy coin for the crowd. This is from TU-Dev, and they take this coin and give you a cup. They're trying to be sustainable, and since this is from TU-Dev, they did not accept it in Utrecht University, and in 2 months they are going to stop using disposable cups. So then, if you don't have this coin for €1, you cannot technically have coffee if you don't give into the system. So now everyone's starting to have these coins just so that they can follow the rules. It's kind of forced upon us rather than our own mind trying to or not trying to be sustainable or buy a coin.
I mean, I guess that in the model this would again be HFT. I mean, this HFT can be a constraint.
No, but it's not my choice to buy this coin.
It is.
It's-
You mean you feel forced, but you use some external pressure to inform your choice.
Yeah, and by the way, I mean,
I want to have coffee.
Yes,
I have to buy this coin.
I'm not sure I understand your point because the rules, I mean, if we're starting to speak about rules and question rules, then it goes very far, right? I mean, vaccination campaigns can be involved exactly the same way.
You mean,
So I think we're on a kind of slippery slope here.
do you mean you don't have a free choice because you're
No,
in this one?
I don't have a free choice, but I should buy this coin.
All
Yeah.
your choice is influenced by external forces. That-
Not really influenced. I don't want this coin. It's plastic. It's not sustainable.
So government relation rules and so on can be
but
applicable, or other rules that you need to do it without being your choice. Where is that in that from
Anyway, I think it's.
Money is reused, so it is
Still
sustainable.
there, yeah.
No, it's ridiculous, but it's a means to an end. It's not the end.
I can use a one
I think-
coin
I
as
think We should stop the discussion.
Yeah.
Let's say Jean-Philippe proceed
Yeah.
because this is we're not going very far.
So yes, here I like to quote Keynes, one of my heroes. The conventional valuation, which is established as the outcome of the mass psychology of large number of ignorant individuals, is liable to change violently as the result of a sudden fluctuations of opinion due to factors which do not really make much difference. So this is really the thing that's putting head in mind. Have something that's completely irrelevant happening here, and because the valuation is established as the outcome of mass psychology, and this is really what the model is capturing, you can have these violent changes happening because of the existence of this self-fulfilling prophecy social influence factor.
Right,
So-
or is the discrepancy between the perception of the future and the actual underlying more
Right.
probable future is too big, and that creates a lot of room or for upside or downside.
Right.
Yeah.
And then it suddenly, switches
Yeah.
because of something that is anecdotal.
Yeah.
And really, if you
And
think
that
about,
reason is mostly more like a rationalization afterwards. Because it could have been anything that triggers the.
yes, here it's really completely anecdotal. But what happens here has no relationship with the size of the jump.
Yeah.
But what is interesting still is that here, and that's what I was about to say, there are close, if you're close to this point where J reaches this value, then before becoming discontinuous, the curve becomes steep, the blue curve becomes steeper and steeper. So if you want to follow this kind of more closely. So this is the blue curve, which is now red, sorry, but it's smooth, and then as you increase J, it remains smooth, but it becomes steeper and steeper, and at one point, it becomes discontinuous. And so on the way to this steepening of the curve, then what happens is, pictorially, is that when one person switches from minus to plus, it changes the perceptions of others through social influence, and therefore more people can switch. And so if you're in the blue curve, this is mostly irrelevant. But as you reach JC, as you reach the red curve, these avalanches of flipping are going to be bigger and bigger. So as you increase J, as you increase the social pressure term, the decision of one person will have influence on a larger and larger number of people. And so actually, as you reach this critical point, you can plot the distribution of avalanche sizes. So what is an avalanche here is the number of people who have changed their mind just because one person has changed his mind initially. So when you're in the blue curve, it's really maybe 2 or 3. But as you approach the red curve, this distribution of sizes becomes broader and broader. And actually it approaches at criticality, at JC, it approaches the power law with an exponent mu equals to 300. I'm always talking about this power distribution that I talked about yesterday. And so again, we can try to understand that this afternoon. So if you're not exactly at the critical point, there's a broad region where it's a power law and then it gets truncated for very, very large sizes. So this is, and we'll see that this afternoon, this is really the mechanism of that is really the same mechanism as contagion, as epidemic contagion. I guess that we've all been familiar with R0 during the COVID propagation. So as you know, when one person infects on average R0 other people, when R0 is less than 1, then the epidemic dies out. When R0 is bigger than 1, then the epidemic becomes countrywide. And it's actually the same model. We see that explicitly this afternoon, that in this model you capture this effect that when one person changes its mind, or her mind, or his mind, then the probability that it infects someone else, or that it changes the mind of someone else, is reaching 1 exactly at JC. So it's the same underlying mechanism.
Is that the difference between an influencer and an ordinary people? Ordinary in quotes.
I'm sorry?
That could be a bit of the difference between an influencer these days and an ordinary people.
Yeah, right, of course. And here, because here it's it's again a mean field model where everybody influences everybody else only through only through the total consumption. Then there's no influencer in that sense. But now if you put the JIJ on a network where some nodes are much more connected than others, then you have the notion of influencers. So an influencer in this language would be a hub. But I have no hub in this model. I mean, it's possible to include it. But... Okay, so you remember that I've shown you the birth rate curves or the cell phone curves. I haven't shown that it has similar shape increases, or the shape of the decay of clapping after concerts. And what this model predicts is that if you take the derivative of the signal with respect to time, then it should have a shape like this. So it should peak at one point. But the non-trivial prediction of the model is that the width of this curve as a function of time should be proportional to its height to the power minus 2/3. It's a very non-trivial prediction that is due to imitation. If you had no imitation, the width of the curve would just be inversely proportional to its height, because essentially this is a derivative of something that goes from -1 to 1. So height and width should be inversely proportional. But the fact that it's not inversely proportional is a kind of parameter-free prediction of this model in the mean field limit. So what we try to do is to test exactly this. So let me go back to these curves. So you see these curves, they're very noisy, but you can still try to take the derivative with respect to time of these curves, I mean the discrete derivative, and then plot. So that's what you see. You can fit these points that are obtained by taking finite differences. Then you fit the curve and you extract from the fit a width and a height. And then, this part is not beautiful, but at least it suggests that something like this is going on. So for example, these are the birth rates in different countries in Europe. And these are the points coming from cell phones, again, in different countries of Europe. There's not a lot of points, but what's interesting is that if you make a fit through these lines, first of all, if you fit individually the birth rates and the cell phones, you get the same slope. And overall, the slope is very close to 2/3. So let me show you. -0.62 is the slope for cell phones, and -0.71 is the slope for birth rates. And this line here is the -2/3. And this line here is the -1 that would be in the absence of any imitation effect. And so this is the case for clapping. And clapping, we got 0.64. So this is the red line, and the blue line is -1. So okay, so it's not terribly convincing, but you know, it ties up pretty well with the story that in these phenomena there is a social pressure effect, and I guess that we're probably more or less convinced of that at the individual level. I mean, the cell phone is really something that I was happy to do with a student now a long time ago, nearly 20 years ago, because that was my perception, and in particular, going to different countries in Europe, you see that this aspect of not wanting to be left alone clapping is very strong in some countries, like in France, and the etiquette would make you look like a fool if you're alone clapping. Whereas in the UK, it seemed to me, and that because I lived in Cambridge for a year, it seemed to me very different. The atmosphere
And probably related to the world value surveys and on individualism perhaps.
to me.
We have world value survey data on different cultural aspects, and one of them is individualism versus collectivism. And I suspect that.
Yeah, but I would say that individualism is stronger in France than in the UK. So.
Oh.
Not if I remember.
You can look it up.
But
Okay.
it depends a bit on how you define it.
Yeah.
I think that
Because I think that, yeah, okay, that's my, yeah, so it wouldn't tie up exactly with this. Anyway, okay, so this is the data. So I've shown you results for the mean field model, but actually the existence of such a transition between continuous and discontinuous is much more general than mean field. Thank God, because I mean, it's clear that in many cases, the graph of our influence is not mean field, but for any type of graph, again, with sufficiently high connectivity, if the connectivity is too small, then you lose this transition. But if connectivity is high enough, then you always have a critical value of interaction such that below the strength, there's a unique equilibrium and a classical S shape of adoption curves in the marketing literature. But for too strong interactions, then there's this divergent feedback loop where one person changing its mind is creating an avalanche of other people flipping. Okay, so let me tell you again the same story in a slightly different context, which leads to the notion of fragile optimization. So I'm going to talk about the restaurant problem, which is actually a classic also in the economic literature, but with a different twist. I mean, we've all experienced this. It's the same story, but you'll see how it's slightly different. We've all experienced this fact that sometimes this is in Venice, of course, this is Piazza San Marco, and of course it's not the same day. You see here it's sunny and here it's rainy, but I couldn't find other pictures on the internet. But in some cases, these two restaurants are facing each other, and one is completely full and the other one is empty. And it's really interesting to see that over and over again in touristic places. Okay, so now we are going to again associate this H of T as the kind of quality minus price, okay, T. Then there's again this idiosyncratic willingness to pay. So depending on how expensive you might still want to pay or not. And then J here would be the taste for well-attended restaurants. So again, it might be rational or not to believe that because the restaurant is full, it's for good reasons. But maybe it's not. In particular, in touristic places, it's not clear that it is, but people still believe that there is information there. So the filling rate, I mean, if a restaurant, if you decide that the restaurant is empty when phi is 0 and completely full when phi is 1, then the equation giving phi is the probability that idiosyncratic willingness to pay is greater than the price, say, minus something that takes into account the present occupancy of the restaurant. So in words, it means that if the restaurant is well attended, the effective price of the menu is perceived as less, and you're more willing to go there just because it's well attended. Okay, so here I'm taking a sudden specific form for this idiosyncratic propensity to pay, which is just an exponential. That means that, of course, there's a lot of people who want to pay very little, and then as you increase the price that people are ready to pay, you find less and less people in an exponential manner. It's not very important, but that's the model that I took. And then what you find is that this is the graph showing the attendance of the restaurant as a function of the price. In the case where the social imitation term, this propensity to go to well-attended restaurant, is small enough. And so what you see is that when the price is low, then everybody wants to go there because the price is low, so that's fine. And then as you increase the price, then progressively less and less people go there because if you want only rich people can go there. And so this is very natural. That's what you expect. Okay, so full restaurant up to a certain price. And you see that this price actually, this critical price depends already on the influence term. So even if it's a little too expensive, just because people go there makes the occupancy remain at its maximum value for longer.
I'm sorry.
Yes?
So in your population, do you assume that everybody goes to a restaurant? The only question is which one, or do you assume that people can also choose to not go to any of them?
Sorry, here I'm actually even simplifying. I'm just looking at just one restaurant.
Right.
So they either go to the restaurant or they don't.
Yes. Okay.
So there's a single restaurant. We could
Okay.
of course put two restaurants, but you'll see what happens in this case, which is I think already very nice. So now if this parameter j is too high, 2 gamma j greater than 1, then the curve changes completely. This is the same story as before, but I think it's even more vivid here, and actually we'll see why hysteresis and the existence of two equilibria is really problematic. Because what you find now is that as j increases, you can keep your price up for longer without anybody defecting, because j is so large, it's so cool to go to a restaurant where everybody goes that you're ready to overpay, right? But then you see that now at this point, there's a catastrophe. And the problem is that in this model, there's no precursor at all. So at this point, what happens is that suddenly the price is really too high. And so people think again, and because less people are going, suddenly it collapses. And the equilibrium curve jumps discontinuously from attendance 100% to attendance, well, 1/2 gamma j doesn't really matter. And then as the restaurant owner tries to increase its prices furthermore, of course, there's less and less people going there. So the restaurant owner, of course, is tempted to go there because it's favorable to him, right? He's not losing any client and increasing its price or her price. So clearly the optimization from the point of view of the restaurant owner is going to drive him exactly at the point where it's unstable. And of course, nobody knows exactly where this point is. So you might overshoot or undershoot, but anyway, there's a temptation to drive the system where it's most unstable. And then let's imagine that the poor restaurant owner, I mean, I have no particular sympathy, but imagine that he's here now, he's seen his attendance collapsing. What is he going to do? Well, he's going to say, well, maybe I was a little too greedy, I should reduce my price. Then you reduce your price, but unfortunately, you don't go back up here. You stay on the low branch for much longer. And then it's only when you reach this point that you go back to 100%. So this is really, the importance of hysteretic effects, that there's a delay between the path up and the path down, and it takes much longer to recover your initial crowd if you made a mistake. But so what I find really interesting about this model is this idea of fragile optimization, that optimization is making the system non-resilient. And this is a very generic problem, actually. There's a lot of systems in which, complex systems for which optimization drives you to a point of instability.
Yeah. The same for overfishing, huh?
Yes.
So
Sure.
even in I would call it completely rational system where, you can overfish, not realize you're overfishing, then the fish cannot breathe
Right.
anymore because they've been overfished, and then
Sure.
you.
Yeah.
So it's the
So
same.
one thing, you look at a single unit over here. If you have multiple hierarchical levels, you often see that collapses at the lower level tend to stabilize the whole system somewhat.
So what are you referring to?
Small scale collapses, or a single restaurant, for example, they may look dramatic for the restaurant itself, but some of those mechanisms, small scale collapse, they sometimes stabilize or smoothen larger scale systems, which smaller systems are embedded.
Okay, I would be really interested. to see that.
Yeah, I can look up some stuff.
Yeah, you see it also in, what is it, electric networks, you see that.
Yeah. Many,
Small
but
collapses.
that's so the scale you're looking at is important, and also the judgment whether it's dramatic or not.
So that's what I call cliff edge optimization, because you're optimizing and driving yourself at a cliff edge. That I said that it's not symmetrical. And this notion of fragile optimization, as I said, is very generic. And the fact that optimization leads to lack of resilience is something that we investigated recently with them in the context of, well, he investigated in the context of neural networks, but I guess then you know the story, so I want to go through that. But if you reduce the buffers, the time buffers for absorbing delays in trains, then of course you're making the system more efficient, but you might generate a collapse of the system when delays propagate and accumulate throughout the day. So as I said, the problem with some of these models, I mean, it depends a little bit. You see here, there's a kind of precursor. I mean, at least before the collapse, there was an increase that could maybe lead to some warning sign. But in this example here, there's absolutely nothing going on before the collapse. And that's really the main problem. And therefore, we recover this thing that I talked about in the case of fracture, that there are cases where there is a precursor before the failure point. Here you really, you can anticipate that it's strange. You're straining the system more and more, but there's no extra stress associated with that. So suddenly something is going funny in the system, right? It becomes kind of more chewy somehow. But so here you can devise warning signals that tell you that maybe you should be careful. But in these cases, it's really terrible because you have no way to anticipate the fracture. Yes?
Is this phenomena of this restaurant problem also observed in real life data? That, for example, a restaurant increased the price maybe by just a few cents, and then it really.
I haven't tried to look at the data. And this is again a very stylized model. I think the whole point of the model is not necessarily to be compared with data, although it would be interesting to look around and see. I don't think that data is so easy to get, by the way. It's completely private
There is
data.
also another mechanism because from the perspective of a single firm or a single restaurant, their it's income or the turnover or the profit is the amount of sales that they make times the amount of
Minus the cost.
yeah, so if any of the clientele decreases to some extent, the prices are so high that still makes more money. So I think you see what I'm saying. So
No. Here it's not the case. Here it's not the case because you see that there's a discontinuity. So at this point here, the profit between this point and this point has reduced.
also this is really profit. The 5-star.
This 5-star is the attendance.
Attendance. No, but I'm saying that the profit is attendance times the.
The price changes by an epsilon amount.
Yeah.
And the phi drops by a finite amount. So the product
Yeah,
of the two has to
yeah, that's true.
decrease. I mean, there's no way. I mean, this is bad. This is. No, I mean, what I was saying is that I don't think this story is really meant to be taken at face value. Although it could be interesting to find actual examples, and Deb has looked at examples on the railway systems where maybe there's real data to see that as the system becomes more efficient in the sense that, you know, for example, the time between trains is reduced and so on, then it becomes unstable at the same time. But I think that for me, the objective of this lecture and this model is to show that this paradigm of optimization is very dangerous. Because
Actually, many cultures have cultural mechanisms against optimization.
Right,
It's,
yeah.
It's considered inappropriate in
Right.
many cases to.
because of that. And but so I think that, you know, at the very least, when we speak about optimization, we should add a penalty that relates to resilience. So the objective function should be a combination of profits, if you want, minus risk, minus this catastrophic risk.
Yeah, and the main thing is there's conflict between the short and long term.
Right.
And over longer term.
Well, that's not even long term, right?
Yeah.
It's really very rough.
No, but the optimizer will be punished on the long term because of lacking resilience.
Right. Oh, yeah, exactly.
But on the short term, there's a window where optimizer could outcompete.
Yes, but the problem is that, you know, you have to introduce the notion of unknown unknowns and of parameters uncertainty, because here, you know, any model would tell you that you have to be here if you know the parameters exactly.
No, but that's where I meant that there are cultural norms in when it comes to do this. So because when you go up on the top one, let's say, I would say some cultures have a norm and say, oh, there's some internal stress in the person overselling.
Yeah, I agree, but that's what I'm saying, that is that in the formulation of the model, if you introduce some parameter uncertainty, then you will see that this point is not good, because maybe you're here. And all, you
But
know,
in companies, people, the problem in at least in my experience, in most companies don't use this as their model. So they don't recognize that this is even possible.
right.
So they really think that, you know, everything will have statistical.
Sure, everything is well behaved.
Everything is well
And
behaved.
by the way, here, what Deb was saying is true. I mean, here, there's a region where you can increase your price and still make more profits, and that's okay.
And then you can go back.
I would say
Well, you can go back and then there's no problem.
Yeah,
because-
exactly. And the problem is that
So this is a standard optimization
Yeah.
problem. This is a non-standard
Yeah.
optimization.
But I would say a lot of, let's say. Let's go for more simple people, working they have, there's a saying in Dutch that a good name, good reputation comes from food and goes from horseback. I think a lot of people traditionally, well, let's say that work have this attitude internalized. So they have this Theresa's model, somewhat internalized, it's just that a lot of classical economic education.
Yes.
and
It's
they
correct.
believe-
Yeah, 100% agree.
And they believe, honestly, so I even spoke to head of a pension fund who honestly thinks that he can see it coming.
Yeah.
You know, it's, you can see it coming, yeah.
Was your remark also not that the surface basically depends on the culture? Some culture, the surface of that square, almost square he showed, is very small because it's it is internally that you don't want to optimize it basically, and so almost goes to the left, and the other one, and some companies,
Risk versus
yeah.
stability or safety, but that's.
Okay, so you can change the model slightly by saying that instead of jumping from -1 to 1 instantaneously when the sum of these three terms becomes positive, maybe there's a lag, maybe there's a think twice, or maybe you don't. This is your perceived utility somehow, If it's negative, you don't do it. If it's positive, you do it immediately. But maybe, even if it's positive, you don't do it with probability 1. So that's a well-known extension of the model in decision theory to describe the decision process using this so-called logistic model. And beta is the inverse temperature in physics, but it's also called the intensity of choice parameter in choice theory. And if you want, it's describing kind of irrationality. Your utility is positive, but still there's a probability that you don't do it, or that you do the opposite. And so this is a natural extension of the model, both from the point of view of decision theory, but also in terms of physics, because this is the model at non-zero temperature. And so you can wonder whether adding a little bit of beta will completely ruin the whole discussion. And actually, it's not the case. You can draw a diagram in the phase. So now J is fixed, and I'm instead changing the width of the propensity distribution. And it amounts to the same, actually. Here, if the width is too small, then there will be jumps. And if the width is large enough, if population is heterogeneous enough, then you will have a smooth distribution, which makes sense. And so that's the phase diagram that you find in the phase, in the plane 1/beta sigma. So beta goes to infinity is the rational limit, is the case where you flip as soon as ui is positive, as soon as you perceive utility positive. But it doesn't matter actually. So the previous case I was discussing is this one, this line, where you jump instantaneously as soon as your utility is positive, and the only parameter is sigma or j. I mean, you can either change sigma at j fixed or fix sigma and change j. And so you have a region here where you have jumps, and a region here where you have no jumps. So the curve is smooth. And then there's a line here that makes this transition robust. There's a whole region of temperature where choice, intensity of choice, where you get the same phenomenology, and a region where everything gets smoothed out. Of course, if at the individual level people are smooth, then at the collective level people are also smooth. Something else that I want to discuss, because I think it's also very important from the point of view of adoptions of policies, is how you get from the good equilibrium to the bad equilibrium somehow. So this is a pictorial view of what happens. This is, if you want, the collective utility for different parameters. So as you increase the public information, the true optimum, so here the sign is flipped because I'm thinking as a physicist, so this is lower energy, but it's higher collective utility, then the whole society should be here. But instead it remains here for a long time. So if H is 0 in this model, it's the two equilibria are the same, so it's indifferent whether you're up or down. But as you increase this propensity to buy, or the utility of doing the plus action, then clearly there's an optimum that's better than the other one. But if you're stuck here, as I said, it's very hard to get unstuck. So one possibility is using the fact that people are a little bit irrational, and if you wait long enough, then you will be able to go from this point to this point. So there will be a spontaneous transformation of the system, but it's going to take an incredibly long time. It's going to take a time that is exponentially large. So this is something that you cannot rely on. So really, in order to make people transition, you should find other policies. And in physics, there's something quite interesting, what people call nucleation. But in such a model, you can make the system go to the true good state by locally favoring that state. So if you're able to initialize the transition, say, in Utrecht, and then use imitation to propagate the good practice, then it is a way to speed up considerably this time scale for adoption. So, I mean, I'm not saying that this is, again, should be taken at face value, but these types of models, they also suggest interesting policies that could be implemented to avoid these incredibly long time scales. If you just assume that people are going to do the right thing, then you might wait a very long time for that to happen. But if somehow you nudge them in somewhere or another, in particular, making experiments, I think that's why people do experiments, do social experiments. Like in France, there are various départements where things are tried, and then you hope that because things are tried locally, then it's going to propagate elsewhere.
Then you use spatial heterogeneity
Yes.
to
Right.
explore
Exactly.
the landscape.
Okay. Yes, I'm probably finish here by another example where, well, actually, it's a spatial example of social pressure and contagion. So I mentioned that earlier. This is a map of kind of spatio-temporal map of the way the riots in 2005 propagated. And so you see that there's a non-trivial pattern. But we were interested with a student of mine called Christian Borghesi in the very non-trivial patterns that you can observe in election turnout. So this is the participation rate, I mean, the fraction of people who actually go to vote when they're entitled to vote in a European election in 2004. So we have different European countries, but actually we've looked at different countries, different elections, and you get always the same type of patterns. So what is striking when you look at this map is that it's not at all random. I mean, some regions, participate a lot. So in France, for example, this southwest region has turnouts beyond 85%. And then other regions are actually very low turnout. And it seems that there are, long-range correlations that this region is very large, this region also, but there are also micro patches. So it's a multi-scale phenomenon. There's something else also that you should see by the eye, is that there are discontinuities. So for example, Alsace, which is bordering Germany, has a completely different pattern. And the same here.
Even in Germany, you really see the different provinces, the borders between them.
Right. And here also between, Pyrenees North, which is France, and Pyrenees South, which is Spain, they're completely different participation rate.
This
Yes.
resembles a lot the images that you get from segregation models, like Schelling's model of segregation, where you have types of people that would like to be close by to each other, and you get these clear regions of clusters of people. Is this anyhow related to this?
Okay, well, depends how you formulate the Schelling model exactly, but here is it's in a way the opposite. So if you assume, okay, well, first of all, let me tell you that first that you can quantify the correlation, the spatial correlation of these voting patterns. So this is what you get. So C of R is the average correlation of the voting propensity as a function of the distance between 2 points. So this is 10 kilometers, 100 kilometers, 500 kilometers. So that's the size of France. And what you see, this is a log linear graph. And what you see is something that's very straight in this representation, which means that correlations are only falling down logarithmically with distance and not at all exponentially with distance. I mean, the simplest thing you would get, and for example, in the shedding type model, if you're not including the right ingredients, you get exponential decay. Or if you look, for example, at the density field, the way France is inhabited, then you get an exponential correlation, not a logarithmic correlation. And what's interesting is that this logarithmic correlation has been then seen by other authors in different countries. So we've seen that in other European countries, and here is a study by San Miguel in Spain, in the US, and you see, so these are different elections, and what you see is a logarithmic dependence that goes to bigger distances because the US is larger, but it's also very straight on this representation. And what is interesting is that if you make a very simple model where people are influenced by what their neighbors are doing, then this logarithmic dependence falls out very naturally. I mean, you don't have to assume much. You just say, what if people are eager to vote in city X, then in a nearby city 5 kilometers away, there will be oral exchanges between people, and some of the people will be convinced to go vote because their neighbors do vote. Then it's enough to generate this very non-trivial pattern. So that's an example, another indirect example of how we're sensitive to imitation and social pressure. Okay, so let me finish by this idea of tipping point, which again we've emphasized that several times, which is that these models here, they lead to abrupt changes with nothing happening. So this is really why I wanted to show all these examples where something abrupt happens with nothing explaining them, is because this model here is a kind of, as I said, a unifying model for this type of unexpected result, unexpected event. And so that's why I recall what Barack Obama stated when he pronounced his inaugural speech in January 2009. So it was just after the crisis had begun, and he said, it was very strange because nothing really happened. There was no destruction of any kind. So he said, our workers are no less productive than when this crisis began. Our minds are no less inventive. Our goods and services no less needed than they were last week. But still, everything changed. So it's very strange to think that in some cases, these change of mood that are collective, they can have an impact on people's lives when nothing at the fundamental level has really changed. It's just a question. It's a question of perception. And people suddenly start. So I had a friend who was in New York when Lehman collapsed, and said it was amazing because the week after, people stopped going to shops. Shops were empty. Some people were going to the bank and taking cash in plastic bags. And I mean, there's really an idea that suddenly the world has changed because of something that actually the subprime sector was the minor sector of the US economy, but still it had a completely outsized impact. So that's why I like these models that explain what can happen in terms of as soon as we are not only concerned with the objective information, quote unquote, but also what others think, then we can be in a bad shape. So I've also insisted on the cliff edge optimization paradigm. And of course, I've mentioned that, and you also mentioned that yourself. This concept of tipping points, which was actually introduced by shedding, is important for many aspects of social engineering, vaccine, hygiene, nudge, tasks, speed limits, whatever. And by the way, there's this very nice book of Schiller called the Narrative Economics, where he emphasizes the role of these narratives in how perceptions are shaped and how narratives can have an actual influence on the real economic economy. I recommend that. And actually, in the book of Schiller, he also speaks about things about narratives as viruses and their propagation as a contagion. It's a very close type of idea. That's it, folks.
And it's the same Schiller that predicted the real estate crash.
Yes.
Yes.
Robert
Yeah,
Schiller.
so like
He's an-
not the anecdote that economists are not that good in predicting.
Yes, sorry, you had a question.
So, I want to understand the bigger picture.
It's already a big question. Okay.
What is your ambition in the research beyond intellectual curiosity and solutionism? At one point, we are trying to understand all these peaks in economy, stock markets, and trying to calm the economy in a way, not have too high peaks or too lows. But at the same time, we are also trying to increase the revenue of a restaurant by changing certain elements of this cost things. So that will actually in return cause peaks and sharps based on it's a very
If we're not careful.
so what are we being careful about?
So, I mean, again, what I try to show here are toy models, toy examples of what can go wrong in classical thinking. And that's really the aim. I mean, at this point, it's very far from being predictive models. The spread-form model is ludicrously simple, and it's not meant to predict anything, but it's just meant to make people aware that these traditional concepts of optimization can be very dangerous, and the idea that peaks and jumps reflect something deep about the economy or the structure of the world may be completely misguided in the sense that they might come from something very different, which is our propensity to imitate our peers, and not at all because of actual jumps in the fundamental value of companies. Or so we should, there's misplaced focus on these peaks if we believe that they're due to something fundamental. So that's my ambition beyond, of course, looking at simple models. But I think that simple models are important because they shape the way people think about the world. So if you have the model that's classical economics model, you see the world through that prism, and you're very biased. And so I think it's important to give alternative pictures of what may explain what we're seeing in the world.
Just one last follow-up on this. The optimization model from the restaurant, it can be used in US stock people who want to make money out of it and can cause sharper peaks or more ups or more downs. So then it won't really calm the economy.
How would they use this model?
I don't know the stock market. I'm just trying to gauge that understanding how to optimize cost can also work against the good that we think is.
That's what I'm trying to show. That's precisely what I'm trying to show.
Can you put it in your words what you're
What I'm trying to show is that when you just try to optimize something, you may cause
There's a trade-off.
bigger problems by destabilizing the whole system.
Trade-off between stability and profit maximization.
Right.
And if the Fed would be using your model to predict the cliff, they shouldn't publish the exact model because then the
Yeah,
market
but
would
that's
be
also
paying
why I think it's important to have these models in mind when you try to think about regulation, because regulation can be unwittingly destabilizing the system, or take into account the right feedback loops and stabilize the system. So, for example, there's this very famous financial transaction tax that people, I think, a completely misguided understanding of, because people say we should, introduce a tax to the stock markets to reduce volatility. But actually, when you look at data and when you think about the mechanism, it would increase instability rather than reduce instability. So if you say we want to tax stock markets because we want to make something out of that, levi of money, then fine. But you can't claim at the same time that you're going to stabilize the stock market because it's not true. So I think that's why it's important to understand the system that you're dealing with before trying to alter any prescription.
The same as like the ban on short selling doesn't
Yeah,
provide,
of course.
of course. Yes.
Are you also saying that if you have multiple of those models, some you can use for macroprudential to prevent basically crises, and others you can then use for optimizing, and they are competing between each other, either going more for profit or in the whole market, or going more for a prudential market system based on all the choices you make.
Well, yeah, I think one of the biggest problems is that what people call models means something completely different depending on people. I mean, some people call models things that help them making money if you want, or they don't really want to understand what the model means and what are the deeper consequences of the model, but they just press a button and the model is fed with some data and spits out something. So that's a model. That can sometimes be very good. I mean, all these deep learning language models, I mean, nobody understands what they really rely on, but they're extremely efficient. I mean, they're amazingly efficient to produce
For
results.
some purposes.
Yeah, for some purposes.
Yeah.
But of course, not knowing their limits it can be dangerous. And then there's the other side of the spectrum of what people call models, which is what I tend to do, which is not trying to have a model that explains anything particular, but have a model that explains that gives you the right intuition about the world, which, not claiming that you're going to calibrate the model and have exact predictions for observables, but things that give you an insight about what can happen. For example, the shedding model that was mentioned, this shedding segregation model. It's a very interesting model, in my view, because it tells you something very non-intuitive, but it's not meant to be calibrated on real data. If you want to do that, it's much more complicated. You should include a lot of details that are thrown out of the model. But still, the basic message of shedding, which was that you can have racial segregation in cities without people being intolerant to diversity, is a very insightful model. I would claim that it's like, these models are shedding light, but a little bit, to have this insight that you can have this cliff edge optimization problems that appear very naturally, where you want to do the right thing and push the price as high as you can until suddenly, the floor disappears and then the feed. And I think it's an interesting thing, even if there's no actual restaurant data showing any of this. Maybe this is just completely pie in the sky from the point of view of restaurant, but still, I think it contains a message that is overarching and important. That's what coming back to your question. That's what I would like to do. It's finding.